There are 3 points in every trade, and they are point number 1. So whenever you place a position on the broker, and then there is entry price, then there is profit target, and then there's stop loss. So there are 3 points in every trade, and their entry price, the price that you enter with, the profit target, and the stop loss. So for me to give you an example, for example, here the entry price, the profit target will be in the top, the entry price will be in the middle, and the stop loss will be at the bottom. So for example, the stop loss between 2 currencies could be 1.5713, and then the entry price 1.5743, and then the profit could be now profit target, you set that profit target, it could be anything, 5773. So as we can see that the profit, the entry price is here, the profit is there, and the stop loss is there. And we can also change it a bit. So there's a 30 pips difference between the entry price and the stop loss, and we can also say that our profit target could also be by 30, which is now at 73. So we are trading on 30 pip difference between the 3 entry points. So let's look at an example. Let's take example of a long position. So we can say GBP, for example, this is an example right here. GBP USD, the price is trading at 1.5743. Now, because let's say you expect that GBP will get stronger and it will go up, so you enter into a long position. Enter in a long positions. Okay. So now once the price has been locked down, so one thing is now completed. So the entry price is completed and we can knock that out. So now there are only 2 things that can happen. One, that it can go 30 pips and you make a profit of 30 pips, or the stop loss of 30 pips again. And once these values are locked down, between these 2 things, you either make a profit or loss. Now, needless to say that it's possible that after the entry price, the price goes up to say 50, which is over here, 1.5750. You could still be in profit and you can still take that trade, but then usually it's maybe wise to just leave it at your what you define before you enter the trade, because then on one trade you would be spending too much time, and it's not worth changing when you begin starting placing the position. So it's not recommended that you make a change and start selling in the middle. So it's not recommended to do that. Now, whenever the distance between, so this is the distance between the profit, between target profit. So this is actually not a profit, this is a target profit. So that whenever the distance between the target profit and stop loss is equal, it is said to have the risk and reward ratio to be 1:1. Now, in the same manner, we could also do a short position. So this was the long position example. And if I do the short position, we can just say that the stop loss is at 0.18168, and then the entry price could be at 0.8138, and the profit target could be 0.8078. So here we can see that the difference between the stop loss and the entry price is about 30 pips, and then again the difference between the target profit is 30 pips again. So then again the profit ratio is 1-to-1. Profit, we can call that risk reward ratio. Okay, there has to be 1 over here. Yeah, now it's better. Okay, wait a second. Okay, I think it will be 0 here. That's better. Okay, that's better now, because now this is the 30 difference, 30, and is going downwards, and this is a short position. So the risk reward ratio is 1-to-1. Now, however, in another example, if let's look at this one. If let's say this was 1.78, so that means the difference between 0.8138 minus 0.006 is 8078, which is here. So this would be as 1-to-2 a risk reward ratio, because we are getting 60 pips towards the distance between the profit target and stop loss. If you're not sure about what pips are, watch the module regarding pips to understand how many decimal places and how they are calculated. So it is recommended to always use stop loss for every trade, and this happens for most of the traders who are more experienced to always have a stop loss. If you do not have a stop loss, then it's possible that you don't close the trade out because it didn't go towards your target profit, and then you can lose a lot of money, and which is not very good, because when the currency goes in the opposite direction considerably, it's very unlikely that it's going to return at the same spot. So I will show you a chart and I will show you what I mean by that. So this is a chart, and I will change this to a bar chart because it's more easier to understand. Okay, and I will remove, yeah, this is a better chart. Okay, so for example, if this is the USD/JPY currency chart available for free on easytradingschool.com, and then I'm looking at the USD/JPY. The trading is happening here, and I'm looking at the 1-day trade, which is over here. Now, because I want to focus on one particular area right here, I'm going to zoom in and I can press 1 day, 1 hour, 30-minute chart, and 1 minute chart. So you can see this is a minute by minute, and I can also increase it to, for example, 1 week or 1 month, or I can set my own range. So I'm gonna do, let's say, 1 minute chart, and I can see that, let's say I bought the currency at this price, which is 112.96, and because it's going upwards, I want to take a long position on this one, and I want to set a stop loss somewhere around here. So if I'm doing the 30 pips, this would be around 112.92, and your target profit will be 112 point plus whatever this is. So let's say 30 pips, I will do that over here. Okay, so 112.957. now this is the lockdown price, which is the middle item entry price. So let's just suppose that I took a trade on over here, and now I'm gonna go back to my Okay, I'm gonna go back here, and my target profit is plus 0.03, so 30 pips. So this is my target profit. So 112.987, and this on the chart is actually over here. It is exactly over here. Now we can see that the currency is trading somewhere along this line here, and if I zoom out a little bit, I can see that where is 11.987 on this chart. 11.2987. It's exactly over here. So this is the 30-minute chart, and we can see that it is possible that sometime today that the USD and Japanese yen, it's going to fluctuate between this area, because we can see there was already fluctuation from here. It was 113, and then after about, so this is at 10:30, and now it is at 11:30. So this is 1 hour difference. If you see the time over here, you can see that. So this is 10:30 and this is 11:30. So at 10:30 it was trading at say 1113.112, and then after 1 hour it changed to 1113.34. So the difference between this and this is about 100 pips. So that means there was a huge profit happening here. Now of course you may not know that which way the trend is gonna go reverse, so you might be somewhere here and you might be closing somewhere here. So this right here, the top and the bottom, the difference here is 100 pips, and with that you can calculate how much profit you can, what is the value per pip, as I showed you in my previous module. And you can see how much profit you would have made, and depending on what was your leverage and your margin amount. So you can see that there's a huge profit here. There's an absolutely huge profit here. Now this chart here, this curve right here, this translates into thousands of dollars. Basically, that's how much money you can make on this. Now of course you would have to put $1,000 to make the $500, but if you put down $100 in your trade, let's say if you put $100 in your trade, you're definitely going to make tons of money. It could be another 100, so that's 100% profit. Okay, so the numbers get bigger. And if you're trading with a small amount, then the numbers will stay smaller. And this is something we're going to talk more about in our other module. So for now, this is enough which I showed you. So we'll go back to our the example which I was showing. So I was talking about that to always use stop loss. Capitalize that. Stop loss function, always. Okay, so this is a rule that you're gonna remember this, and you must do this always, and always use stop loss. It's never recommended to not use the stop loss function, because you've had some winning trades and you have built some confidence and you think that you're in control, but this is absolutely wrong thinking. Stick by the rule of the experienced users, and always use stop loss function. Now if you do not use the stop loss function, then it's referred to as a naked trade. So a naked trade is when not using stop loss function. So never use a naked trade, because as the name suggested, you are absolutely unprotected, and it's not good that it's cold outside and you're walking around naked. This is a naked trade. Traders run the risk of losing their whole balance of the account just because they didn't use the stop loss. So do not use this practice. It's dangerous, it's responsible, and you're not gonna increase your profits by not having a stop loss.